Friday, September 12th, 6:15 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Next week is a big event. It's scheduled, it's public information. It's Wednesday, September 17th, 2 p.m. Federal Reserve Committee meets. They vote on either changing or leaving interest rates alone. Again, that's the U.S. Central Bank, aka Federal Reserve. That being said, this is the U.S. dollar index, 5-year chart, each candle a week. Look at this yellow horizontal line. That was the high of this year. The US dollar has been declining. Here's a low of the year. For the week, close red, lower high, lower low. The trend is down. US dollar value is declining. It's a markdown phase. Costs more dollars to buy products and services for us here in the States. That being said, let's go look at the history of the yields. This is the US Treasury Department. Oops. Another federal agency. Again, the US Treasury sells fixed income products. Why do they sell that? Because Congress, that's the legislative body, and the president, the executive body, those two powers of government spend more money than we take in. Then how do you pay your debt? We sell US Treasury yields. There's different durations, 1 month, 6 month, 1 year, 5 year, 10 year, 30 year. And they have different interest rates, yields, aka yields, interest rates, and they fluctuate during the market hours. We have to convince people to buy our debt to be able to continue spending, because again, we don't take enough tax revenue in. In the past, when interest rates go down, you have members of the government, Congress, and the president, instead of paying down the deficit, see that we're paying lower interest on our balance, so they continue spending. That's degenerates. Here's a 30-year yields for a duration of 5 years. The yields are going up. Well, this past week, new low, lower low, lower high. Lower yield, lower interest rates. This is the 10-year yield. Same thing, lower low, lower high. But back here, here's the low of this year, real far away for the 30-year. The 10-year, we're almost at the lows of this year. The 5-year, yep, new low for the year. So the shorter duration is near the lows of the year. And the 2-year yield. It's testing the low of last year. This is the low last year, right there. So again, the shorter durations are near the lows of this year. This is the scheduled, again, for that meeting next week. It's counting down. This is the market sentiment for next week. The current target rate is between 4.25 and 4.50. Over 90% of investors are anticipating a quarter reduction for next week. Then we have another meeting in October. 81% of investors are speculating the rates will be again lowered. And the last one this year will be December. 76.3% anticipating, speculating rates will be lowered again. Market sentiment has a history of not always being right. The U.S. national debt, I shared this several weeks ago when we made a new all-time high. We broke $37 trillion. That's a lot. That's a lot. Yeah, the U.S. debt, $37 trillion since those few weeks ago. We added over another $470 billion to the debt. Yeah. So not only, again, did we break that high, 37 trillion, we're almost halfway. Yeah, that's crazy. That's ridiculous. Again, the executive branch and the legislation branch, Congress and the White House, are the ones that are spending this money. Degenerates in charge. Again, we don't take in enough tax revenue, nor do we sell enough treasuries to pay this down. We're only paying the interest on it. So the debt keeps growing. So for the month of September, these are the U.S. treasuries that we're selling. The first horizontal line was the first trading day of this month, and the bottom horizontal line was today, the close of today. So if you bought the 1 month treasury yields on the first day or the second day of the month, you would have been earning 4.40. First, if you bought it today, earning less. Yeah. Short-term duration, lower. Let's look at the 6 month. First day of this month, first trading day of this month, 3.99. And down here went lower, 3.83. Let's go to 1 year. 3.82, 3.66. So let's go to higher duration, the 10-year, 428 and 4.06 yields. And let's go to the 30-year, 497, 468. Yep. Lots of changes. Again, public information is not a secret. So you can see overall, the yields are declining. So who would want to invest in fixed income when you're earning less? Yeah, that's another problem. If we don't continue getting people to buy our debt, often we have to encourage them. How do we do that? We raise interest rates on these yields. Again, we have to have a certain amount of income continue coming in to pay for a deficit. We're only paying the interest. And we have leadership that is not reducing spending. That's a problem. Hopefully you have your family financials in order. Thank you as always, spending just a little time with me. That's it for the video. Thank you for watching.